Hello, friends. 2026 is fast approaching. In 2026, tax brackets are set to automatically go up. In retirement, when taxes go up, your spendable income either goes down or your portfolio distributions go up. Now, no one knows the future, but it's widely accepted that taxes overall are likely going to continue to increase over the next decade or so. The Congressional Budget Office has stated that taxes are expected to go up by 66% by 2030. The interest alone on our huge national debt is approaching $1 trillion per year. Think of that. So here is a look at the federal budget. If you look at this chart, it goes back to 1962, and then it projects to 2029. And so you can see back in 1962, the mandatory portion of the budget, meaning Medicare, Medicaid, Social Security, etc., was only about 26% of the budget. Today, you can see how that's just gradually and steadily increased over time. The interest on the debt, pushing out the discretionary. So the discretionary amount of the federal budget that they can actually, kind of choose to fund all the various programs, activities, military is approaching 25%. So we really have a lot of pressure, financially speaking, on the federal budget. The tax rates are historically low, and so we really do believe taxes are going to be higher in the future. So what does this mean to you? If most of your assets are in pre-tax accounts, like IRAs or 401ks, then your spending income goes down every time tax rates increase. Now, forget about all the complicated tax rules, FICA, and anything else that can be taken from your paychecks or distributions. And let's only talk about the federal tax brackets for a minute. So assuming you had $150,000 annual income, you might pay around $23,106 in federal taxes based on the current tax brackets. That's an effective tax rate of 15.4%. Now let's take the 2026 expected tax brackets and run the same $150,000 of income. You would pay around $28,134 in taxes, which is an effective tax rate of about 18.7%. So that's a little over $5,000 extra taxes. Here's a quick breakdown. First, these are the current tax brackets, right? And if you look at this breakdown, you can see that the net annual income after tax would be $126,894. And now we compare that to what taxes are set to go to. The current tax code is set to expire, sunset, January 1st, 2026. And so they would revert back to what they were in 2017, assuming there's no new acts of Congress that change this. And so based on what's set to go into motion, you can see that that's going to result in just a little over $5,000 more tax than you had the year prior in that situation. Another way to look at it is that you would be able to spend around $5,000 less in income in 2026. So if you still need that $5,000, you would need to increase your total distributions from your portfolio by around $6,700. That would give you the same spendable income net of tax. Basically, when taxes go up, your spendable income either goes down or your portfolio's distributions go up. Those really are the options. The more income you want, the bigger the gap gets. And let's just look at a higher income. Let's assume a $300,000 household income. You can see with our current tax brackets, total tax $58,085, effective tax rate 19.36%, and a net annual income of $241,915. Okay? As of 2026, what we anticipate, there would be an additional $13,213 of taxes. Taxes will probably be your largest expense in your life. Investment planning by itself is not enough. Income planning by itself is not enough. Proactive tax planning is routinely ignored, but is vital to preserving your assets and income in retirement. Tax minimization planning can help you have more control and allowing yourself to maintain a certain lifestyle based on a certain amount of spendable income. Proactive tax minimization considers income needs, portfolio design, Social Security optimization, lump sum versus pensions, Medicare, IRMA brackets, required minimum distributions, legacy planning, and so much more. No matter where you land within the tax brackets, your taxes will probably go up soon. The question is, do you know what you can do about it? Most CPAs and tax advisors are dealing with the current year's tax liabilities. Most of them do not provide proactive long-term retirement tax planning. Many financial advisors can't or won't provide tax planning. The professionals at my firm, Martinsen Wealth Management, specialize in holistic retirement planning. We can and do provide tax planning for people just like you. If you want to learn more about how to effectively minimize your taxes in retirement, I invite you to visit thefinancialfastlane.com and schedule an appointment, no obligation, to have a conversation. Either way, I look forward to seeing you in the next episode of The Financial Fast Lane. Hey, welcome to The Financial Fast Lane. My name is Lane Martinsen, and today I am here with Ken Holmes. Ken is one of the financial planners on our team, and so we've got some questions and answers that we're going to do here today. So,
in your book, you mention how there's times when we kind of have to unlearn maybe something that we have learned in the past.
Yeah.
Could you elaborate a little bit on that?
Yeah. I think it was Yoda who said, what did he say? We have to unlearn what we've learned. Unlearn it just means learning more about it to where you understand the full picture and realize that there's some things that are no longer true. Things that used to be true, some things are just simply not true anymore in the realm of financial planning and financial services.
Yeah. The best thing for me is to always put into my IRAs, my 401ks, right? I want to take that tax deduction today because I'm going to be in a lower tax bracket when I retire.
Yeah.
When you retire, you may not be in a lower tax bracket. Let's not even take into account the fact that taxes could increase. Let's say taxes never increased, right? You've probably gotten this too.
Yeah.
How can I be in a higher tax bracket if taxes never go up and I'm actually not making an income anymore, right? What are those big things that we may lose in retirement that we have while we're retiring? Right. Let's kind of elaborate on that as an example.
Yeah. Well, yeah. I mean, the tax laws have changed a lot. While you're working, you've got deductions. You're contributing maybe to a 401k, getting a tax deduction. You maybe have, child credits. You have all these things that when you retire, they go away. And so the whole scenario, the idea that I will be in a lower tax bracket in retirement, that was just so broadly taught and accepted. And now with our massive, national debt and deficits and historic low tax rates, there's a significant risk the taxes will be higher and it will probably be in higher tax brackets in retirement. So tax planning becomes, in the retirement years, just becomes a huge issue that really hasn't been that in decades of the past.
Right. Going along with that, how many people have you worked with that say, Lane, I hope I make more or less money in retirement?
Right.
Right?
Right.
I don't see that.
Yeah.
I've met a lot of individuals that just are not wanting to be in a lower income
right
than when they were working before.
Yeah. And the studies show when surveying retirees, saying, are you spending less in retirement or more in retirement? It's about 50-50. 50% will say, yeah, it's a little bit less. 50% are saying, no, I'm spending the same amount and even more. Because while some expenses go away, there's new expenses that replace. And a lot of times people haven't really thought through that and looked at that. And so most people don't want to go into retirement and then reduce their income.
Right. Right. So if they're not reducing their income, they need to look at other strategies, other alternatives that might actually help with those situations.
Right.
Right. I recently heard a really good example about that. When we retire, we typically want to have our house paid off by the time we retire.
Mm-hmm.
So that's an expense that goes away, right? So maybe we don't need as much in retirement, But right now, typically our other largest asset is going to be our retirement accounts, our employer accounts, 401ks, SEPs, IRAs, those type of things.
Mm-hmm.
But how much of it is really ours to keep?
Right.
We know today what tax rates are. We don't know what they might be in the future.
Right.
But another concept is our IRA is kind of like our mortgage. Do we want to have that tax paid off so we actually know what the value of it is?
Right.
That could be done as an example.
Yeah. It's not fun to plan out your retirement with a bunch of variables.
Right.
And unknowns, right? There's always going to be unknowns. But for example, let's say you've done a great job, let's say you've got $1 million saved up in your 401k, you've been contributing over the years, and it's grown, and you're looking at that, and you're seeing this balance, and you're thinking that that's your money, right?
Right.
And the truth is, you don't know what percentage is actually going to be spendable because it's a variable. The government can change the tax percentage. They have a lien on that money. And so tax play, there's a window of opportunity, and there's a significant, there's a lot of money to be saved with smart, multi-year strategies. And a lot of times people think it's too late. Oh, why didn't someone tell me sooner? It's not too late for most people. We have a window of opportunity. There is some time to get some things done, repositioned, whether we're talking Roth conversions or whatnot. It can get complicated because you can make mistakes along the way. So you want to make sure you get it right. But yeah.
No, that's good. Let's see if we can move on to another question here from.
Okay.
Also in your book, you mentioned that we're living longer nowadays.
Yeah.
Well, how is that? And I mean, how does that have such an impact on why we want to look at things maybe a little different?
Yeah. Longevity risk is a risk multiplier, right? Because the longer you live, the longer you need income. The longer all the other bad things that, all the other risks that could threaten your assets have a longer period of time to manifest. And so then you could get into more health costs or long-term care costs. And so, yeah, this wasn't, retirement planning and the type that we do, it wasn't even a thing hardly, 30 years ago, it wasn't a thing. It was like safe withdrawal rate, get your pension. If you have a little savings, great. And so it's really a whole different world. This generation is the baby boomer generation is now retiring where they have been responsible for their own contributions, their own 401k retirement accounts. Unlike generations before that where they had pensions, much more so, right?
Right. Just like retirement financial planning has changed, the medical industry has changed.
Mm-hmm.
Right. I remember seeing a Time magazine article that says this child could live to be like 150.
Yeah.
And I was going, this is crazy.
Yeah.
But a lot of it's just because of that medical advancements, right?
Right.
There's other things that are going on that could keep us living a lot longer than we were before. Hopefully it's a good, healthy life and not, just being on the feeding tube or something. But with that longevity, our money's really got to last a lot longer. And so just like Social Security wasn't really designed to last nearly as long as it's lasting today.
Right.
Because our life expectancy has changed dramatically.
Yeah.
You hear a lot of financial gurus out there. Mm-hmm. It's kind of a one-size-fits-all approach,
mm-hmm.
which can be difficult, right? Because everyone is unique.
Yeah.
My situation's different than the person next to me. Both of our situations might be a little different. So really actually having a plan specifically built for one individual mm-hmm. is key, because there's all these different tools in the toolbox. You talk about it in your book, but not all those tools fit every individual, right? So just general broad stroke painting is difficult to do. Therefore, listening to some of the top doctors on the radio, not give 100% advice for each individual situation.
For a medical, diagnosis, for one person, it could be very beneficial for that person, could be lethal for another person, right? And so it's really true with financial planning.
I like that example, just because, in one situation, this might be completely perfect for somebody else, it just might not like that. So how do we combat some of these issues right? How do we get answers to these questions?
Mm-hmm.
I know you've got a book that hits on multiples of these strategies.
Yeah.
There's other YouTube videos and so forth, but ultimately an individual consultation, right?
Mm-hmm.
How can that help individuals out there that maybe have never gone through that situation? I know one of the great things about working here, right, is I have access to a lot more tools than I had before.
Yeah.
Some of those software programs and things. Why is that so unique than just going to someone and saying, oh, well, here's a prescription, right, that might fit you because it fit this person over here.
Yeah. You go to a family doctor or you go to the ER or something. And I just did that. I just had this, I jumped off a high dive. I thought I could do something in the air that I couldn't do anymore. And I landed kind of on my side and there was a lot of pressure on my eye. And so I started seeing lights, flashing lights, and I was concerned I might have a torn retina. Anyway, I ended up seeing a doctor, and he looks at it and he says, yeah, you need a specialist. You need to go to the eye doctor, ophthalmologist, right? And while the one doctor was skilled enough to say, you need a specialist, the specialist, I get to his office, he's got all the tools. Now, who do you want to deal with? The generalist or the specialist in that situation? It's the same with financial services.
So let's say we have some individuals out there that want to go see a specialist.
Yeah.
How do they do that? Or how much does it cost me, right? Because that's another big thing.
Yeah.
I want to see what my plan looks like, but how much is this really going to cost?
Yeah. So, I mean, you want someone that you can trust. You want someone that's ethical. When you find someone that you want to work with, if you go to the doctor, they're going to ask you for all the details. They're going to ask you, they have to know all the details in order to make a good recommendation. It's the same with holistic financial planning, right? So if someone comes to us, they schedule a free consultation, we can talk. There's not so far you can get. It's really, let's dive into the details. So we need statements, we need tax returns, income, history, real estate. We have to see the whole thing, and then we've got the tools to do some planning, create efficiencies, create income. Anyway,
so they can reach out to us.
Yeah, sure. Yeah,
right.
Of course.
And then we can help put together a plan, a prescription, so to say, for their individual situation.
Yeah, well, absolutely. Yeah, martinsenwealth.com is our website. Free consultation, if you're interested in that. So, yeah. Hey, I think we'll probably run out of time on this video, but Ken Holmes, great man, good man. Great to have you on our team. Thanks.